أعوذ بالله من الشيطان الرجيم بسم الله الرحمن الرحيم الحمد لله الصلاة والسلام على رسول الله السلام عليكم ورحمة الله وبركاته. We are going to discuss chapter 3 today, which deals with the accounting information system. Accounting information system is the process of collecting and processing data and then preparing financial statements with that data, then communicating the financial information to the decision makers. Most businesses nowadays use a computerized accounting information system, otherwise known as ERP system, which stands for Enterprise Resource Planning. The processing of the data in accounting information system starts with a transaction, which is an event that can be measured in economic terms. Not every event is a transaction. A transaction usually affects one or more of the elements in the accounting equation, namely assets, liabilities, or stockholders' equity. Every transaction has a dual effect, meaning at a minimum, every transaction affects two accounts. Here are a few examples of what can be or cannot be a transaction. The first one is the purchase of a computer, which obviously is a transaction because you can record it with economic terms. The second is discussing a guided trip with a potential customer. This cannot be recorded in economic terms unless the customer purchases the trip. So this is not a transaction. The third one is the paying of rent, which obviously can be recorded in economic terms. Therefore, it is a transaction. The processing of any transaction begins with analyzing the transaction to figure out exactly what part of the accounting equation is affected by the transaction. And as you can see, the basic accounting equation, which we discussed in a previous chapter, assets equal liabilities plus stockholders' equity. The transaction has to be placed in this equation, and the elements must be identified, the elements which are affected by the transaction. Here is a further breakdown of the stockholders' equity section in the accounting equation. The stockholders' equity section is made up of two elements. The first one is common stock, and the second one is retained earnings. The retained earnings is made up of revenue minus expenses minus the dividends. The revenues and the expenses are reported on the income statement as we discussed before, and then net income is calculated. Dividends are paid out of that net income, so the retained earnings ultimately is made up of net income minus the dividends. In these next few slides, we're going to look at a few transactions and how they affect the accounting equation. The first event is on October 1, cash of $10,000 is invested in Sierra Corporation by investors in exchange for $10,000 of common stock. So what happens when the common stock is sold to the investors? Cash increases, so we increase the cash on the asset side, as you can see, $10,000 added in the cash column, and then also on the stockholders' equity side we have $10,000 added. So now the equation continues to balance. Next, we have on October 1, Sierra borrowed $5,000 from Castle Bank by signing a 3-month $5,000 note payable. So the company borrowed money. When they borrow money, what happens to cash? It increases. So you see the cash column has $5,000 added to it, and then on the other side of the equation we have $5,000 added to liabilities, which is under the notes payable column. Next, we have on October 2nd, Sierra purchased equipment by paying $5,000 cash to Superior Equipment Sales Company. So now cash decreases, so we have $5,000 cash subtracted from the cash column, and then we have another asset on the same side of the equation, which is the equipment, increasing by $5,000. Again, you will see for every single transaction we have either one or more elements in the equation affected, but the equation continues to balance. The left side continues to be equal to the right side. Next, we have on October 2nd, Sierra received a $1,200 cash advance from Arnox, a client. So now the client of the company paid $1,200 in advance for service that they're going to receive in the future. So what happened to cash? It increased by $1,200, as you can see. On the other side of the equation, we have something called unearned service revenue, which is a liability because the company has to provide this service in the future. Remember, a liability is something that the company owes. The company has to give either money or service. So now this is recorded under the liabilities side of the equation. On October 3rd, Sierra received $10,000 in cash from Copa Company for services performed. So you see cash increasing by $10,000, and on the other side, under stockholders' equity and retained earnings, revenue is increasing by $10,000. So we have revenue $10,000 added, and then we have received cash on the other side, and cash increased by $10,000. Next, we have on October 3rd, Sierra Corporation paid its office rent for the month of October in cash for $900. So you see cash decreasing by $900 on the left side of the equation, and on the right side under expenses, $900 is subtracted. So the $900 paid as rent is rent expense, which is coming under the expense column, which is under the retained earnings, which is under the stockholders' equity. Next, we have on October 4th, Sierra paid $600 for a one-year insurance policy that will expire the following year on September 30th. So we have $600 cash reducing, and then we have $600 prepaid insurance. Prepaid insurance is an asset because the company is going to get benefit of the insurance services over the next year. So this is recorded as an asset. Next, we have on October 5th, Sierra purchased an estimated 3 months of supplies on account from Aero Supply for $2,500. Now, on account means that they have received the supplies, but they have not paid for the supplies yet. So you would see on the asset side, supplies inventory increasing by $2,500. But on the liability side also you will see accounts payable increasing by $2,500. So they will have to pay for this sometime soon. They haven't paid cash, so nothing happens to cash. Now next, there is an event that happens on October 9th. Sierra hired 4 new employees to begin work on October 15th. Now these employees were hired, but they have not worked nor have they been paid. So actually we cannot record an accounting transaction for this event. Next, we have on October 20th, Sierra paid $500 in dividend, so cash decreased by $500, and then you also see $500 under dividends. The last event is the employees have worked for 2 weeks and they have earned $4,000 in salaries which were paid on October 26th. So you have $4,000 cash reducing on the left side, and we also have an expense of $4,000 on the right side. Now if we add both sides, all the transactions that took place on the asset side and on the liabilities and stockholders equity side, you will see that they add up to $23,300 on either side. So the equation always will balance if you record the same amount of debit and credit, as we are going to learn in a very short while, inshallah. Now, every single account in the asset or liability or equity has what we call a T account, which has a debit side and a credit side, like you see on this slide. And certain accounts are debited when they increase, and certain accounts are credited when they increase. For example, cash is an asset account. When cash increases, you debit cash. When cash decreases, you credit cash. For every single transaction that we looked at least one account must be debited and at least one account must be credited. This is called the double entry system in accounting. Also, the amount of total debits must always equal the amount of total credits. However, the individual T accounts only show the debits and the credits made to that particular T account. So you see this example of a T account where $10,000 and $8,000 were debited from transactions 1 and 3, and then $3,000 were credited from transaction 2. Then you add the two sides and subtract the smaller amount from the larger one and show the balance on the larger side. So here we have 10,000 plus 8,000 minus 3,000 equaling 15,000, and it's showing on the debit side because the larger amount is on the debit side. And here we have one more example of the same, except in this case the larger amount is on the credit side and the balance is showing on the credit side. For asset accounts, the normal balance is a debit balance. In other words, when assets increase, we debit, and when they decrease, we credit. So normally the assets have a debit balance. The opposite is true for liability accounts. When liabilities increase, we credit, and when liabilities decrease, we debit. So the liabilities have a normal balance of credit. The normal balance of the total stockholders equity account is a credit because we credit the account when it increases. Underneath the stockholders equity, we have the common stock, which follows the same. The normal balance is credit. The retained earnings also have the same credit balance. However, the dividends are opposite because when the dividends increase, we debit. And the dividends reduce the retained earnings, so it only makes sense that the dividends behave exactly the opposite of retained earnings. As for the revenue, we credit when it increases, so they have a normal credit balance. And for expenses, they have a normal debit balance because we debit when expenses increase. Here you see the connection between the balance sheet and the income statement. We have seen before the assets equal liabilities plus stockholders equity. The stockholders equity is made up of common stock and retained earnings. The retained earnings is made up of revenues less expenses, which equals to net income. And the net income is added to the beginning retained earnings, and any dividends paid are subtracted from the beginning retained earnings, resulting in the ending retained earnings, which is reported on the balance sheet. Here again you have the summary of all the normal balances we discussed in a previous slide, the normal balance of assets and expenses are debit, and the normal balance of liabilities, stockholders' equity, and revenue are credit. Another illustration for looking at the increase and decrease of the different elements in the balance sheet and the income statement. As you see here, assets and expenses, the first and the last one, are debited when they increase, and the liabilities, the equity, and the revenue, you see the three in the middle, they are credited when they increase. Here we have the accounting equation, and underneath that equation the normal balances of the different T accounts for assets, liabilities, and stockholders' equity, and then whatever is included in the stockholders' equity. There are a total of 9 steps in recording a transaction from the beginning until the end. The first step is to analyze each transaction. The second step is to enter a journal entry which includes at least one debit and at least one credit. The third step is to transfer those amounts into T accounts. Here you have a further breakdown of those 3 steps, looking at what happened, which is analyzing the business transaction, then recording a journal entry which includes a debit and a credit, as you can see, and then the third step is to transfer the debits and the credits into individual T accounts. The fourth step is to prepare a trial balance from the T accounts. The fifth step includes recording adjusting entries. The sixth step is preparing an adjusted trial balance. The seventh step is the preparation of the financial statements, which includes an income statement, a balance sheet, and a statement of cash flows. The eighth step includes recording closing entries, and the final step is preparing the post-closing trial balance. So this brings us to the end of this chapter. Included in this chapter are exercises that we're going to do practicing all these steps. And when we practice these steps in class and when you do them again at home with a few practices, these steps will become easier and easier for you, inshallah, and you will be able to comprehend each step better, inshallah. So with that, we finish our lecture for today. Subhanakallahumma wa bihamdik, ashhadu an la ilaha illa anta, astaghfiruka wa atubu ilayk. Assalamu alaikum wa rahmatullahi wa barakatuh.